So we're back with you again, Bucks and Brews. Where Nick and I are coming to you from the same location because our wives are sick of how loud we are, and they can't get anything done when we're at the house. So we're back in our new little spot here. Next time we'll have a little banner over our head.
We're hoping.
Nick's brought some fun beers, but I'm gonna tell mine first. So I'm same as last week. I got peanut butter porter from Saugatuck. I got toasted marshmallow milkshake stout from Rochester Mills. Nick, what you got?
I took a drive this weekend to Frankenmuth, and so stopped at the brewery up there. Got a Christmas Town Ale from Frankenmuth Brewing. It literally is the most wonderful beer of the year. It's such a good Christmas holiday beer. We talked about a new banner, but one thing we want to talk about.
Shout out to my wife.
Big shout out to Dawn. Like I jumped for joy and excitement. We got some new Bucks and Brews glasses that we're going to be able to drink out of tonight.
Those are cool.
Tonight we're joined by a very special guest, a guy who I've actually never seen what he looks like until I friend requested him. I don't know, 6 months ago on Facebook. I've talked to him on the phone. He's literally gotten me financed on 90% of my real estate deals. I've given him over to David so that he can do some refinancing, some purchases. But Rob De La Torre, he's a mortgage broker.
Lender.
What's that? A lender?
Lender, mortgage lender.
Perfect. So, and you'll tell us the difference here in a minute because I'm dumb. That's why we bring the professionals in. So we've never met. I tell this story to everybody. I was like, the guy that gives me the most money, I've never met. I've never shaken his hand. I can tell you that, about his kids. I can tell you where his kid went to college. Like, I know so much about this guy. We have never met. And it's been a great real estate journey because, right, it's not that necessarily emotional connection. So he has my best interest at heart because he wants me to keep coming back this way. So Rob, thanks so much for joining us. Tell us a little bit about yourself and what you're drinking tonight.
Hey, right on. Rob De La Torre with Loan Depot, residential mortgage lender, Loan Depot. I don't have anything exciting that I'm drinking tonight. I'm a cider drinker, so I just got a Wicked Grove cider.
Oh, there you go.
Nice.
We love cider. That's pretty exciting. I say.
I'm a big cider drinker. I like all the ciders, especially the fruity ones. The raspberries, the peach, the mango. And then you get into some of the craft beers that have the berries in them. As long as they're not super, super, super sour. I like the fruity beers.
I say, I drink a lot of beer, fruity beers, ciders.
Fruity drinks.
Yeah, I say fruity drinks all day. So right, we have to start out with that first question because apparently I still don't know the answer. What's the difference between a mortgage lender and a mortgage broker?
Yep, mortgage lender is we're lending our own funds, so to speak. So for instance, I'm an employee of Loan Depot and we underwrite, fund, close, and service all of our loans. A mortgage broker is usually employed by themselves or maybe employed by someone else, but they're not the ones actually providing the loan. They're going out into the marketplace and shopping your loan to different lenders like myself or other lenders and getting paid a fee for doing so.
Okay.
Back when we first met, well, no, I was a lender back then too. Prior to 2005, I worked for a mortgage broker. And at that time, that was the better setup than working for a bank or a mortgage lender. Mortgage brokers at that time did at least 2/3 of all of the residential mortgage business. But the housing crisis of 2008 to 2012 really put the hammer down on mortgage brokers. Not necessarily just the economic downturn, but all the regulation that came through the housing crisis. Long story short, basically now all folks have to have skin into the game. And what I mean by that is the lender is responsible for verifying the borrower's ability to repay. And if that loan goes bad, there's liability all the way up the chain. Under the old mortgage broker formula, once we did that loan and closed it and it was delivered to where we were sending the loan to. We never saw the loan again. I mean, of course, we kept the relationships and established with the folks involved, but as far as the mortgage went, we had no idea where it was at, where it could go to, couldn't contact anyone on it, and had zero financial liability on that loan. The regulations came in, which was a good thing because now everyone has to be responsible in their lending. A lot less fraud when you might have to write a check for $150,000 on a mortgage if there's fraud involved. I mean,
Yeah,
the lender meaning. So there's not too many mortgage brokers out there anymore.
Okay.
Very, very few. So in the marketplace right now, really, you're talking about banks, credit unions, and mortgage lenders.
Okay.
Very, very few brokers.
So that's good information to know. Right. We want to bring up, I mean, we talk about the old days, and as I said, you were my first person that I went through for a loan, and you're pretty far south of me. I mean, you're an hour and a half south of me. And
St. Joseph, Michigan.
Yeah, I went to go buy my first house when I was 20 years old. And the only way, it was a foreclosure, but the only way I could really get financed and was like a 403B or some type of a loan that's not even out anymore. And you were like the only person that could loan on it. And I don't know how I had the right person that connected me with you. They're like, nobody in the area does it, but there's this guy way down here that does it. And I was like, I'll talk to him. So, we had the opportunity back then to take out funds to do rehabs and on the property, but we denied it because I just wanted my mortgage payment and to pay cash for my repairs. So, which looking back was the smartest thing I've ever done. But tell us what you guys offer in your business, because one of the big reasons I wanted you on was because you can do so many different things that most people can't outside of the normal lending is what I would call it, right? So tell us, I guess, what sets you guys apart from other companies?
Yep, and it's nothing special. Basically, when it comes down to lending, you have the entities involved, requirements for doing a loan with them. And what I mean by that is if it's a conventional loan, you're dealing with Fannie Mae or Freddie Mac. They have their own set of underwriting guidelines of what qualifies to be a loan with them. You have programs like FHA, and I know from your questions, we're going to get into all these different programs later.
Oh, yeah.
But what is different about us is that whatever the criteria is for the loan product or program, pretty much is all that the borrower needs to meet to obtain that loan, which, like I said, isn't anything special. We're meeting the criteria for, say, FHA. FHA has their regulations of what a borrower has to meet for the criteria. And as long as the borrower meets that criteria, we're going to fund the loan and get folks into the house. Other banks or credit unions or other lenders, they'll have what are called overlays, additional lending criteria on top of that. Okay. And it's all risk-based analysis. If a particular bank, credit union, or lender had a lot of loss in a certain category, they're probably going to slap an overlay on top of that and try to limit their risk and not lend in that area anymore. For instance, investment properties. A bank or a credit union may only, one of their overlays might be that they'll only finance borrowers on their owner occupied property or second home. They won't finance investment properties.
Sure.
And that's just that particular lender's internal overlay or internal requirement that they adhere to lending to. And we don't have any of that over on top of what the program requirements are, which the program requirements are, reasonable enough to limit the risk in the lending industry. We just don't have anything on top of that. Sure.
Let's say you'd mentioned FHA. Can you tell us, I guess, what FHA is versus a conventional loan? Even I guess throw in VA, some different types of loan, but what's the difference between FHA and conventional, I guess?
Yep.
I know for me it
FHA is
costs a
a
lot.
FHA is a government sponsored loan program, and it is for only owner occupied purchases. So the borrower has to be purchasing a property that they intend to occupy. And it's one of the lowest down payment products. It's minimum 3.5% down payment of the purchase price. It has the most relaxed credit standards, allowing borrowers a second chance. You know, if they've had a bankruptcy more than 2 years ago, or they could have possibly even had a foreclosure more than 3 years ago, FHA will give them a second chance. They have a lower credit score requirement to qualify than a conventional loan does. And the reason they're able to do all of this is it's backed by the government, so to speak. It's a government insured loan. So they're taking on some of the risk. Conventional loan are Fannie Mae, Freddie Mac, the two government servicing agencies and lenders participating in that arena. And so to speak, there's not a second person there to help bear the risk like there is in FHA. So credit score requirements are typically higher, down payment requirements are typically larger. So there's not really a downside to either product or program. Really, it would come down to which product is going to best serve the client with where they're at that point in time, as far as credit score or funds available that they have to go towards a purchase. Some of the only limiting factors, FHA does have a maximum loan amount. They won't lend over a certain amount. A single family home loan amount has to be below $331,760. So if you're trying to buy a $500,000 home, you're not going to use an FHA loan to do that. You'll need to use a conventional loan.
Sure. And now with conventional loans, so if I'm financing $1 million on that, can I get it with 5% down?
Not on a conventional loan. Well, not on that size. Conventional loan has a conforming loan limit as well. Boy, you're putting me on the spot here. It's somewhere around the neighborhood of 520.
Okay, so
Maybe.
yeah, that's not bad.
You can do that with as little as 3% down under certain instances, or certainly 5% down.
I've gotten 5% from you. That was my first loan, and that was like a rocket. And that, like, I feel like you've never given me a chance to get 5% again. So I just have to figure out how to get all this. So
once you go over the conforming loan limit, you're in the jumbo loan market, and typically you'll need to have 10% down in the jumbo market.
Sure. And now, sorry, so I know one thing I deal with a lot with you is because I try to get you to lend on, my commercial properties because I just like dealing with you. But so conventional and FHA is strictly 4 units and less, correct?
Correct. Yeah, not right now. Sorry.
Oh, you're fine.
That's fine.
Residential mortgage lending is 1 to 4 units where the primary use is residential.
Okay.
So if you have a property that is strictly just a commercial property or a mixed use property where there's some residential, some commercial, the residence portion has to be more than 51%. Has to be 51% or more to still be considered residential.
Sure.
So everything that we're talking about today is just coming from my experience of being in the industry since 1995 under the residential mortgage side. I don't know much about commercial, as I've never lent on commercial property.
So real quick, because it's something I love to do, you said you've been doing this since 1995. Just so the viewers know, I was 7 when Rob started doing loans. Because I have to make everybody feel horrible.
What kind of beer were you drinking then?
Yes, PBR.
I was drinking Pabst at 5, so I mean, I graduated in 95, and just to let you know, Rob, full disclosure, Nick's daughter Emerson interrupts our show all the time.
All the time. She finds herself to be a YouTube star. Like,
she just walks right in, starts talking, and then leaves.
It's great.
Right on.
So USDA versus a VA loan.
Yep, USDA is U.S. Department of Agriculture. It's the Rural Development Loan Program, and different requirements for that. Well, a lot of different requirements. First off, the benefit of the USDA and the veteran loan are they are both zero down programs. So rural development, no down payment. Veteran loan, no down payment. Veteran loan, easiest thing to say about a veteran loan is you have to be a veteran to qualify for it, or a surviving spouse. Other than that, there's not a whole lot of additional requirements for the veteran mortgage. They don't necessarily per se have a maximum loan amount. You just have to be an eligible veteran, have been discharged in good standing and honorable discharge. But you, oh, how do I put this? Has to be veteran and spouse. So a veteran and a unmarried significant other cannot jointly be on the loan.
Oh, okay. So,
Rural development, zero down. There are income requirements on the rural development. You have to make below a certain income amount, and that's based county by county, state by state, based off of average median incomes. A 4-person family for the USDA, I think it's around the neighborhood of $84,000. So it's reasonable. It's not really, really low.
sure.
And the home has to be located in a eligible area as well. And U.S. Department of Agriculture Rural Development defines the rural area. I go on their map, plug in the address, and it tells us if it's eligible or not. Pretty much it's outside of the larger metropolitan areas. Like Grand Rapids is a lot larger ineligible area than I have here in St. Joseph.
Sure. To say one of our, I know he didn't use you, but one of our claims to fame is we did an episode on how to buy your first house, and we had some guests on. They were renting, and we were talking about how to do it. And I was like, hey, reach out to Rob, and apparently they didn't, but they ended up getting a rural development loan, and we had him back on. We talked, and I was like, it works, like these guys, and they're out in kind of the boonies anyway. So.
And it's funny about them because Dawn and I were talking about that later, and she goes, TJ and Danny probably don't get a house if they don't talk to you guys. And I'm like, yeah, I know.
Yeah. Say they were, being a landlord, they were like, well, we have a lease and we're going to sign this. And I was like, dude, ask the seller to pay off your early termination fee. Like and I'm giving them like all this advice, and they're like, really? And I was like, dude, that's the greatest advice I've given anybody in my life.
Yeah, yeah.
Ask for this stuff. And they're like, come back and they're like, yeah, we did this. We asked for carpet allowance. We asked for them to pay off our lease. And I was like, and it worked. And I was like, yes.
That's
great.
Awesome.
Yeah.
Well,
So
just to clarify too, they don't necessarily have to be out in the boonies. It's just more rural areas. And let's see, I'm sorry, I'm not familiar with your area as well as mine, but
so I mean, it would be like Dora or Moline up here.
Yeah, or Plainwell for
or Plainwell,
yeah, exactly. I was gonna say Allegan.
Yep, Allegan would be.
You could buy a home in downtown Allegan, which isn't necessarily rural, but it's certainly not Grand Rapids.
Sure.
So it depends on the area. You don't have to be out in the boonies. You just have to be out of the major metropolitan area.
I call anything 5 minutes farther, or anything that's more than 5 minutes away from a Meijer, the boonies. So, right? Like
Plainwell has a Meijer.
Yeah, Plainwell's Meijer is way far away, though. Okay. So, but.
So let's get into a few of these here, Rob. So let's say I want to buy a house. Okay. How do I know what I can afford? Like I'm just starting the journey and I'm like, hey, time to buy a house.
Yep. Well, hey, with what rents are, and rents are continuing to increase just like home prices are, I encourage anyone and everyone to buy a house as quickly as possible, as long as you feel comfortable with it. Yeah, I'm a landlord too, so I'm shaking my head at the same time. Yeah, buy a house as soon as you can, as long as you feel comfortable with your ability to repay. If you feel comfortable with your job or your ability to continue to work or increase your wages, maybe it's not at the same employer or whatever it is that the person is doing. You feel comfortable with your ability to earn income, buy a house, no question about it.
Sure.
But to get to your question, really talk to a lender, but I'll give you some basic parameters. But first step would definitely be talking to a lender, bank, credit union, mortgage lender.
I say we can be honest, right? Everybody give Rob a call, and we'll let you plug your email, your all that at the end. But You don't
Right
need
on.
to tell them to go to anybody else but you. I mean, we have you on. We're so small as a podcast. We can literally plug you as much as we want. So,
Right on. Loan Depot.
There you go.
But no, a good range is you don't probably want to take on a mortgage payment, including taxes and insurance, more than a third of your gross income. So let's just use some round numbers. If you're making $3,000 a month, 36,000 a year, you probably don't want to take on a mortgage payment with taxes and insurance of $1,000 or more.
And
That's always a good indication.
you said gross income, right?
Correct.
Okay. So what, I mean, I don't know, it's hard for me because, right, we talk about this all the time. Like, what if you have child support that's coming out and things like that? Like, I like to, I mean, even when I first bought mine, I guess I'm a very conservative investor and very conservative. I mean, even when you first we're going to lend me money, you're like, oh, you can get a way bigger house. And I was like, nope, this is where I want to be.
Yep.
And so it was, I like to go 30% of like your actual net. I mean, that kind of just, once you actually know what the heck you actually have, I like to base things off of real things. I mean, everybody goes, oh, in 10 years, my kid will fall for my child support, or I'll stop being garnished. I mean, chances are if you're garnished, your credit's horrible in the first place, but I'll stop all this stuff. So no, I think that's great to know, like off your gross is 30%. That's a really good thing for people to find out here.
That's under the qualifying guidelines.
Sure.
Now, of course, your approach and the Dave Ramsey approach of 25% of your take-home pay, you're never going to go wrong if you're following those guidelines.
Sure.
I was giving you underwriting qualifications. Your mortgage payment shouldn't be more than a third of your gross income. If it is, you may not qualify for a mortgage. So, of course, if you're taking that to the next step where you're doing 25% of take-home pay, you're definitely going to qualify because that's much more conservative than what the maximum guidelines are.
I think that was one thing I respected about you, right? Like I had set what I wanted, told you, hey, this is really what I want my payment to be. This is what I actually take home. And you were like, these are your numbers. Like, this is what you need to look at for a house if you're going off of these numbers instead of what the qualification. He goes, and he told me, he's like, you'll instantly qualify if you're doing it off of this. And I respected that. And I think that's what made us connect. I mean, back then was like, I'd be talking to realtors and they're like, oh, get with this. And I'm like, this is where I want to be. Stop trying to upsell me on,
right.
Like, I don't want to be on a $150,000 house, broke as crap. Like, I really want to drink beer and just have a place to lay my head. Like, I was young and dumb. So.
Well, and when I'm working with folks, that's what throws them a little bit usually is the question I'll ask them is, where do you want your payment to be?
Yeah.
And, Dave, just like you said, well, I don't really know yet. I'm just getting started with this. Well, what does your pocketbook tell you? What does your gut tell you? That's kind of where I start. I'll let you know what you qualify for, and you'll laugh and fall out of your chair like Nick did, because he qualified for about 4 times more than what he wanted his payment to be.
Yeah.
And I would never try to stretch anyone higher than they should be anyhow. But I always start out with, where do you want your payment to be? And then I work out the taxes and insurance out of that and give you a price range to start looking to keep your payment in comfortable range. Well, it doesn't matter what you qualify for. It matters what you're going to be able to write the check for each month to make your payment.
Well, I know when I was looking to refi, I asked Nick, I'm like, all right, Nick, what do you do? Because I have a unique situation. So he said to call Rob, and I sent Rob a message. I'm like, listen, this is a unique situation. I have 2 houses. I have a mortgage on both. And I really want to refi. And he had to work with okay, well, what is the second loan? Well, it's not really mine, but I'm a co-signer on it. It's really for somebody else. They pay the bill. And how can you help me? And honestly, Rob has worked really hard to find a way to refinance this loan to the point of he sends me a message. I said this to you. He sends me a message a couple of weeks ago. He goes, what's this $45 balance? I'm like, that's my Speedway credit card. He goes, yeah, we need to pay that. I pay it every month. Yeah, well, we're going to have to pay that off before closing because that hurts your debt to income. Sure, I can pay anything off that you want me to pay.
It was only $45, so I figured let's not sweat it and keep moving forward.
Yeah.
If it was $4,500, we'd have to talk a little bit more about that. and adjust the craft beer budget. But
Yeah, absolutely.
We're going to adjust that by getting sponsors on this thing. So right when Frankenmuth Brewing wants to sponsor us and give us free beer, we're going to drink it on here.
We got excited the other day because Onside Ales liked our little post there.
Something small. So, I have higher interest rates, which is crazy to say because mine are actually pretty low. From back in the days, and when you were lending out a long time ago. All the older people that I talk to in investing, they're like, oh, interest rates were 17%, and it was cheaper to do land contracts at 10, and people were happy. And I'm like, what do you like? I've only known things like 6 and below. So I guess what affects interest rate? Like I see every day, it seems like it's, oh, hey, new lowest interest rate, and all my friends are over here getting 2%, and I'm sitting at 3.25 and getting ticked because I'm like, oh, I should refinance because I could do, so.
Oh man, a whole lot of things go into interest rate. We could talk for hours about that, but to get down to the nitty gritty, basically it comes down to the mortgage-backed security market. What happens after someone gets a mortgage is those mortgages are pooled, and then they're bundled together and are basically an investment of multi-million or multi-billion-dollar scale, whether it's an FHA loan, a conventional loan. And the mortgage-backed security market has a lot to do with where interest rates are. Of course, economic items going on. The COVID crisis has affected interest rates. Inflation affects interest rates. But we've been stable on interest rates, goodness, since probably 2005 in a 3 to 5% range. The days you're talking about, that was before I got in the market as well too.
Okay.
When I first got in this business, the first mortgage I wrote was 10%, and then everything else was 9, 8. We broke out the party hats in 1997 when we hit 7% and refinanced everybody that had ever gotten a mortgage in the previous 20 years.
Sure.
But we've been in a stable, low interest rate environment and should continue to be there for the foreseeable future as well. I mean, I don't think we would see double-digit interest rates in our lifetimes going forward, but you never know. But there's a lot more stability going on in the marketplace than there was 30 years ago when we had those interest rates as well too. They're low right now because of the COVID crisis, because of the economic crisis followed by the COVID crisis, but also because of the uncertainty in the bond market going on as well. Bonds ultimately are what determine interest rates.
That's good to know. I mean,
Yeah.
it's like it's funny back in the day. I guess I never knew that, because back in the day, older people are like, they give you bond certificates and all that because they're going to be worth stuff, and now everybody laughs at you if you're going to invest into a bond or give somebody a bond. So,
because the yields are so low on them.
Yeah.
So people talk about this. What's the difference between your interest rate and your APR?
Yep. Great question. That's our wonderful government helping consumers understand the lending process, requiring what's called an APR, an annual percentage rate. Your interest rate is the note rate. So when Nick asks me, hey, what's my interest rate if I buy this house? And I tell him it's, 2.875, that's your note interest rate.
Okay.
The APR is going to report higher than that because what they do to calculate the annual percentage rate is all of the costs associated with obtaining the mortgage, the closing costs, the appraisal charge, the title insurance are wrapped into that. And that's what's called your finance charge. And that's divided out over the term of the loan. And it shows you a cost for borrowing. But that's not the actual amount you're paying because you're not financing your closing costs. You're paying those in cash, or the seller's paying them if we structure it correctly. So in a roundabout way, you're financing it through the seller in a higher sale price, but that's for a later discussion.
I'll finance mine all the time.
But long story short, interest rate is your note rate. APR is the total cost for borrowing that amount. So if you're
Sure.
comparing with other lenders and both of our note rates are 2.875, my APR is 3.19 and the other lender is 3.45. They have some additional costs in there that I don't, or vice versa.
Sure.
That's how you're able to compare across different lenders.
So no, I see. It's actually,
But it is confusing.
it is very confusing. I mean, even for somebody like me who's done it like a million times, whatever. Like, I didn't understand that it was all this stuff rolled into it, because like usually I call and I'm like, hey, how much for your title work, how much for all this, and they're like, oh, it's just rolled. And no, like I need to know how much this is all going to cost, because I already have a guy that's going to do all this. And then I just get tired of all these questions over here, so I just go, hey Rob, just write it. Like,
the higher the spread from the note rate to the APR is more cost.
Sure. No, that makes total sense. Hey, so when I tell my friends to hop on Google and type in mortgage calculator, I put in, let's call it $100,000 in it, and it spits, at 4.5% interest, because I always aim high, right? Because I want people to be crazy. But like it just pops out. It pops out. Let's call it $580 a month. But then I get a hold of you, and for some reason my money's always more. So I guess what goes into a mortgage payment itself? Like what's all rolled into that thing?
Yep. Mortgage payment has your principal and interest payment, which is what we were just talking about. It'll have 1/12 of your property tax amount. So that'll vary depending on the subject property, but to get qualified, we're going to use a baseline, an average amount for taxes in the price range that you're looking. It'll include 1/12 of hazard insurance premium, home insurance premium. Just like with your car, you have it insured in case there's an accident. Your house is insured. Not necessarily in case there's an accident because your house isn't moving, but there might be a fire or there might be a tree fall on it or wind damage. So you're going to have insurance on the home. And then depending on the loan product or program, there might be private mortgage insurance wrapped up in your payment as well too, which I know we'll get into what is PMI and why do I have to have it and how do I get rid of it as quickly as possible.
We're in it right now. Why don't you, because I had it for a minute and I was tired of it 2 seconds into it. So
Yep. But back to the payment. So that's what your mortgage payment includes. When you're on Zillow.com and plugging around numbers and it shows you, this house is this price, your payment is this amount. Typically, it's only showing you the principal and interest portion payment for that house, assuming a 20% down payment. So that's why it's always more, because most folks are not putting large down payments down at these low interest rates. Sometimes it may not make sense to do that. Borrow more money, keep more of your cash, and either invest in more real estate or pay off some debts somewhere else. Maximize your budget and your monthly cash flow.
Sure.
So payment is taxes, insurance, may or may not have mortgage insurance depending on the product. Getting into what PMI is. PMI, private mortgage insurance. That is a part of your mortgage payment when you have less than 20% down. And it'll depend on the loan program. The amount will vary based on the loan product. FHA has a different mortgage insurance amount than a conventional loan does. It can be risk-based. So if you have a lower credit score, you might pay a little higher PMI than if you have a higher credit score. And then some loan programs don't have any mortgage insurance at all if you don't have 20% down. For instance, we were talking earlier about VA loans and rural development loans. Both of those products do not have PMI or mortgage insurance. They have other things in there that help reduce or spread the risk on those products and programs, which I'll explain in a moment, but they don't have a PMI, so to speak. So when you have less than 20% down, you're going to pay mortgage insurance. It's the easiest way I explain it is it's reinsurance that we as the lender are required to carry on the mortgage in case there's a default and I don't mean you personally, the borrower, in case there's a default in general, we're not on the hook for the whole entire loan amount because we've had it partially insured for the 20% we didn't require from you to put down.
Okay. So
Once you
yeah,
pay the loan down, 20% from the original amount you borrowed on a conventional loan, that mortgage insurance will be removed, assuming a positive payment history. If you're habitually delinquent on the mortgage, they don't have to remove the PMI, no matter how much you've paid it down. And then on the FHA loan, the PMI is on there for the life of the loan. So part of your budget structure will be, if you're in that mortgage still, after you've built up 20% equity, it's going to make sense to refinance probably to get rid of the mortgage insurance.
sure. I said I did that. I did that kind of right away.
Yep.
I'm gonna say, 'cause-
Well, you had instant equity from buying that foreclosure. It was
Yeah.
worth almost double from what you paid for it at the time.
yeah, say that was and you know, my first one wasn't FHA. My second property actually was FHA, the duplex that I moved into, and I had equity in that right away. But I was still, I almost backed out of the loan because of PMI. I'm like, I'm not paying for something that doesn't do anything for me. I was like, this is horrible. But
Well, it does something for you in a roundabout way. It allows you to buy it without putting a whole lot of money down.
yeah,
But
it's
no,
like,
I get what you're saying. It's not doing anything for you other than allowing you to put less money down.
and that was the thing. Like I had to put 3.5% down on my second property after I put 5% down on my first. Like, I mean, within 6 months, I literally had two properties, and I was less than 10 grand into both. I mean, it was crazy. You know, it was like a light went off in my head. Like, wow, this is pretty easy, and this is how this works. Like, I have to work 3 weeks, and I have a down payment. And then I quickly realized that stops once I stopped moving.
So one of the things that we might hear about when we're looking into this, Rob, is locking in your interest rate. What does that mean?
Yep. When you get a purchase contract or even on a refinance, whatever the rate is that particular day, you can lock in on that rate, meaning that is your rate, no matter if rates go up or down through the process until we get to closing. And I know that was one of your questions as well, too. How long does this whole process take?
Yep.
In a normal market, it should take about 30 to no more than 45 days. And I'm still seeing that currently now, but turn times are much longer just because mortgage volumes are tremendously high right now with these low rates for both purchases and refinances. But more than just the volume market that lenders are trying to manage, it's getting appraisals back in a timely fashion. It seems real estate appraising is a dying trade. We don't see a whole lot of folks going into it. There is a nationwide shortage of appraisers. I think I heard a couple months back the average age of appraiser in the United States was 59 years old. Average.
For anybody watching, that was literally hey, if you want a guaranteed job, making some money, here's something to go into, right? Like, we're in Grand Rapids, and you know, it's known for medical, and everybody was. It's funny because my wife went in. She's an occupational therapist, and oh, hey, this is the big thing that you need. And then she got out of her school after 4 years or whatever the heck it was. It was like, oh, these jobs are already filled. We need nurses now, and then we need, you know. So, but no, that's all. How long do you have any idea? I know you're not an appraiser. Do you know how long it takes to become an appraiser?
Yeah, I believe, now don't hold me to this, but I believe from talking with some of my appraisers over the years, the requirements have gone up significantly since the mortgage meltdown. Prior to that, I don't think you had to have any formal schooling. But currently, I believe the requirement for an appraiser is you have to have a 4-year degree. Doesn't really matter what in. And then I believe you are a apprentice underneath a licensed appraiser for 2,000 hours, I think. So that's usually about 2 years that you're working underneath somebody as you're learning the trade. And then you can become a licensed appraiser. And then there's different levels of appraisers as well, too. There's licensed appraiser, there's a general appraiser. I don't know what the different requirements are other than education and liability levels and certifications
Sure.
across those, but
Huh.
it's not super challenging to get into the real estate appraising industry.
I mean, I'd have to go back to school and actually like I tell people I get into real estate because I'm uneducated. Like I don't have a college degree. I went to school for bowling. That's they offered me a half ride scholarship to bowl, and I was like, okay, here we go. Man, so if you're not using your college degree and you want to make real money in a job that's looking for people, become an appraiser. That's what I would say.
I would certainly think so, because they are in super high demand right now. With the COVID crisis, a lot of them are choosing not to work right now, creating an even greater shortage. Some of them are refusing appraisal orders if they have to enter the homes, because different appraisal requirements depending on the loan will have. Some of them can do a drive-by appraisal where they don't actually enter the home. They do stop at the property, maybe walk around from the outside, but they don't actually enter the home. And some of them are only doing those types of appraisals right now. Others that are requiring a full entry into the home. Yeah, I mean, hey, we're in the midst of the COVID crisis. There's higher risk. Some appraisers are choosing to take less of a workload. Some have retired early. And we definitely need a lot more real estate appraisers. So yeah, if you're watching or listening, I think it'd be a great career to get into.
Man, I say, I'm not going back to school, but I really should become an appraiser. I mean, I do my own appraisals now, right? BPOs. I'm not even a broker, right? Like my own.
Right.
I do a Nick opinion. That's what I do, right? This might be worth that. I'm hoping. Here we go.
Well, and you're using the same basis financials to come up with that. What properties, similar size, style, structure have sold within the recent 6 months?
Yeah.
I mean, that's pretty much the same information an appraiser is using.
Without a 4-year degree, I just saved 120 grand by educating myself. We talked about mortgage rates quite a bit. Back a little bit of time ago. Even now, I guess I still have some friends that have adjustable rate mortgages and fixed rate mortgages. Can you tell me what the two are and the difference between them, and if one's a better product and why?
Yep, you bet. Fixed rate mortgage means whatever the note rate is that you execute at application and or lock in at is what your interest rate is over the term of the loan. So you get a 30-year mortgage at 2.875%. You're paying 2.875% compounded interest over the 30-year life of your mortgage. It's never going to change.
Unless you're smart and start paying off your mortgage early, the rate won't change, but you'll pay your house off early. So
absolutely.
Don't let it be 30 years, people. So
absolutely. And then an adjustable rate mortgage is kind of what the name implies. The rate is not fixed. It will be stable for a certain period of time, and then it will change either up or down, depending on what market factors and what the basis that your adjustable rate mortgage follows. So give you an example, most common type of adjustable rate mortgages are the 3-year, the 5-year, or the 7-year. So what that means is your rate is fixed for 3 years if you're doing a 3-year adjustable. Upon your 37th payment, 3 years, 36 months, same interest rate. Upon your 37th payment, your note rate can change either up or down depending on what market forces are doing at that point in time. Sure. And depending what they are as compared to when you first took out the loan. And sometimes there's caps on those as well too. Your interest rate on that 37th month sometimes might not change more than 1% up or down, or there might be a 2% cap. And then usually there'll be a lifetime cap on it as well of 5 or 6%. So let's say you're at a 3% ARM right now, and if it had a 6% cap, it means that's not going to go over 9% over the life of the loan. But market interest rates are going to have to be at 9% or more for your rate to go up that high. The mortgage rate is floating over the term based off of the underlying financial factors, typically in the bond market or some type of index. And that is what's determining the interest rate.
So what do you know what an ARM is at right now versus a fixed?
Yes, not much different than the fixed at all because both are super low and the margin between the two are virtually non-existent right now.
Okay.
Um, I haven't originated just because it doesn't make sense to. Back when interest rates were, 4.5 to 5.5%, you might have gotten a percent or a percent and a quarter, or even up to a percent and a half lower doing an adjustable rate. That's a big enough, depending on the loan size, to make a difference. Right now, with virtually no difference between an ARM or a fixed, maybe an eighth or maybe a quarter percent, it doesn't make sense to not take that fixed rate because I don't think you're ever going to adjust lower than where we're at right now. Your adjustable is probably only going to go higher once
Sure.
we find out what our new normal is and we get through this COVID crisis. And rates are back in the 3 to 4, certainly no higher than 5% range. I mean, fundamentally, that's where we probably should be right now. It's just the economics determining lower rates right now. They
Yeah.
will go higher once we get through this COVID.
Okay. Listen, that's good to know. So, I mean, if anybody's thinking about refining, right, you're thinking before the end of COVID, you should refi.
You're in the market to refi now.
Okay.
So closing's coming up. What do I need to bring? How much do I have to pay?
What do you need to bring and how much you need to pay? Well, what you need to bring, of course, is yourself, possibly to closing. With COVID, we have a lot of hybrid situations going on right now. When I refinanced my mortgage back in May, the closing agent came to my house, rang my doorbell, set my closing package on my doorstep. She went back to her car. I went out, grabbed my package, came inside, sat down at the dining room table. She FaceTime called me. She had me set the phone where she could see me sign everything. I signed everything, put it all back in the envelope, set it on the doorstep, came back inside. She got out of her car, picked up my package, and took off.
Wow.
That was my
Okay.
closing. Pretty wild. But typically on a purchase, you're going to go to a title company to close because the seller's selling a house, you're buying the house. There has to be that third party to transfer title and do all the things that they need to do on a purchase. So normally you're going to go to a title company. You'll bring yourself, you'll bring your driver's license. Sometimes you'll need a second form of ID. That second form of ID can be anything with your name on it, either social security card, passport, work ID badge. I've seen people lay their credit card down and the title agent, doesn't take a picture of it, but scratches out the number to show that that's you. And you're going to bring your funds needed if you need any. Some of these loan programs, you don't need a whole lot of money to purchase. Probably the instance with your folks that purchased on the rural development loan. If I have a client using a USDA rural development loan and the seller's paying all their closing costs, usually they don't need any money at closing, or if they do, it's very minimal, or they may even get money back at closing up to the amount they've put into the transaction, their earnest money deposit.
Sure.
Which is crazy to think of. Who buys a house and gets money back? Yeah, but it happens all the time.
No, and that's a way to think about it. I mean, right? You can buy something and actually have somebody pay you some money.
Well, you're getting back your money in the form of the earnest deposit because you can't get back more than what you've put in.
Sure.
But you can structure the transaction where it's literally costing you no money out of pocket to buy. And if you feel comfortable making the monthly mortgage payment, that's a fantastic way to structure it. If you have $3,000, $4,000, $5,000 saved up towards a house, it's not a lot of money, but it's enough to buy a house. But boy, as soon as you become a homeowner, Nick, you're going to have to spend some more money, aren't you? There's always something.
A lot of money, right? Like, I don't know why people own homes. I tell people this all the time, like, right? I don't know why you own a home. It's the dumbest thing you've done, right? It's an expensive bank account.
How many do you own?
A lot, but people tell me it's worth it, right? But I still haven't figured out why. We're in a spot right now, and I think a lot of people learned from the 2008 to 2010, 11, whatever it is, that crisis there, where I feel like appraisals are kind of, they're coming back a little lower, like, or, or close. So what happens if my house doesn't appraise for the value I'm trying to buy it for?
Yep. Well, from a lending standpoint, if we get an appraisal back low, less than the purchase price, then boys, it is difficult. I'm not going to lie to you or kid you. It's difficult and challenging to get a reconsideration of value. There's going to have to be a material defect on that appraisal in order to get it changed. And what I mean by material defect is a mismeasurement. The house is bigger than what the appraisal shows, or maybe the appraiser did not use more reasonably available comparable sales that help support the purchase price. It could be a number of items. Maybe the adjustments from the comparables were not reasonable, or should have been adjusted more or less. There's a process that you go through. Basically, what has to be done from my standpoint is I have to submit to the appraisal management service 3 additional comparable sales that support the purchase price. And these are sales, not active listings, not pending. These are closed sales.
Sure.
And I get those from the realtor, because I'm not an appraiser. I'm not a real estate agent. I'm well versed and knowledgeable enough in values, but I usually get those from the real estate agent. The AMC will internally review them. If they see that there's merit there, then they will put those to the appraiser and say, hey, why didn't you consider these, or can you explain, or can you advise further? The reason it goes through the internal round first is, let's say you've got a 1,200 square foot, 3-bedroom, 2-bath ranch, and one of the comparable sales that you're submitting for reconsideration is a 2,400 square foot bi-level. That's not a similar size, style, and structure. It's a completely different house. That one is not going to be considered for value. I mean, it may in real unique circumstances, which we don't have time to go into here, but pretty much you're wanting to look at other ranch homes, similar size, style.
Same. I think I remember my first house, it's a farmhouse in the middle of a city. And I swear to you, it's like they did a 2-bedroom. I have a 5-bedroom, 2-bathroom. They did like a 2-bedroom, 1-bathroom house, a 4-bedroom house. Like it was nothing comparable like to what I was owning, because there's nothing else that's gonna sell just like it. So they were like, here, these are some numbers that we kind of came up with. So I know that we talked about one when I was going for, you can do a reappraisal if you want, and then hire another company to do a third appraisal to try to get them to meet in the middle.
Well, possibly. If you can only do that if the lender determines the existing appraisal is not accurate and can't be used.
Okay.
And that's rare.
Hey, I get into rare situations all the time.
Yeah. But no, it's not just let's say we're working together, you're buying a house, the appraisal comes in low. Hey, Rob, send someone else out there. Let's get a second appraisal. Sure. I can't do that. There has to be merit as to why a second appraisal has to be done. 15 years ago, 10 years ago, yes, that could be done. Since the HVCC rules, which stands for Home Valuation Code of Conduct, came out, there are industry guidelines and standards to the appraisal process, and there's a formal process that you go through to get a reconsideration of value. And it's challenging, but it can be done. More often than not, though, unfortunately, the appraised value stands, and usually that means, unfortunately, the seller's probably taken less for the house and just come down to the appraised value, because how do you release someone from a purchase contract and expect that the next person coming in to buy it is going to be willing to pay more?
Sure.
Challenging situation, because again, it's an opinion of value, and 2 appraisers may view the same house and have a different value. So it is still one of the areas of our industry that could probably use a little further refinement, so that that isn't happening. And
when all these people are watching
super frequently.
Yeah, when all these people that are watching to become appraisers, like, just know, like, we we rely on you to make it worth $1 million. No, so I think that's that's a big thing to me, is like appraisals. You said it exactly. Like the seller usually has to come down on the price because somebody said this is what it's worth. Now, is there any other way, I guess, besides the seller coming down on price that I can
Well,
still?
the buyer can pay more. The buyer can pay the difference if the seller holds their ground and say, I'm not selling it for less than what we've agreed upon. And let's say it appraised for 10,000 less. The buyer can come in with that additional $10,000 if they have it and if they want to, if they still want the house. And that has happened. I have one right now that we're closing on Thursday. The house under appraised by $12,000. And buyer and seller negotiated back and forth. They met in the middle. So the buyer's paying $6,000 more than what the appraised value of the house is.
And they have to. Now, I can't finance that 6,000 because it doesn't show the value. I have to bring all 6,000 in cash.
Correct.
Okay.
In addition to your down payment.
Okay, perfect.
In
Yeah.
addition to your down payment.
Now,
So
does my down payment go up because of the new purchase price?
Sort of.
Okay.
Let's use some round numbers so we can all do it in our head. Let's say the original purchase contract was 110,000.
Yep.
It only appraises for 100, 10,000 less. And you were doing a 20% down loan. So you were borrowing 80% of 110,000 originally. Well, now since it's only worth 100, you're going to still put the 20% down off the 100 to avoid PMI.
Yep.
And pay 10 grand. So now
So I'm at like 32.5. Yeah, like 32.5. That's crazy. Okay. Yeah, that's
because your loan to value structure all now starts based off of the appraised value. Doesn't matter what the purchase price was. Everything over the appraised value is out of pocket.
And for the people that buy like that, you're the real MVPs to keep raising prices of houses. So my next house can appraise for lower. So that way they have a comparable.
All of this is rare currently and has been for the last several years, only because the realtor is doing their market analysis. They're doing the NIC value before they list the house. It doesn't make sense for a real estate agent to spend time marketing a property if it's not going to be worth the price that they've listed it for. So it's not as common for properties to not appraise since the mortgage meltdown. As when we were in and through the mortgage meltdown, it still wasn't super frequent then, but it did happen. And a lot of the issues that arose during that time frame, and we got a lot more reconsiderations of value during that time frame as well, or just because things were different. For instance, you're buying your house, and across the street and down the road and on the next block are 3 foreclosures. Well, that house that's foreclosed is typically selling at least less than 70 cents on the dollar. That's the reason for it being a foreclosure, is a buyer comes in and assumes all the risk. They don't know if the water's running. They don't know if the furnace is working because all of that's shut off. Thus, the buyer is assuming all the risk. They should be paying less for the property, right?
Yeah.
So an appraiser would use those because they were close, they were similar. In a lot of the subdivisions, where they only do 3 or 4 style homes, they're throughout the whole entire subdivision. I mean, you can't get a better comp than the exact same home down the street. But if that's a foreclosure, it's selling at 70 cents on the dollar. So the biggest argument we had through the mortgage meltdown in valuation is, hey, you have got to make appraiser. When I say, hey, appraiser, you have got to make greater adjustments. You can use that foreclosure home, but boy, you've got to make further adjustments off of that when comparing to this owner occupied home that has a seller disclosure that's saying the furnaces work, the work's fine. I replaced the roof 3 years ago. This is a move-in condition house where the foreclosure down the street might not necessarily be.
Sure.
So as long as they're making the appropriate adjustments from those, it's still an accurate comparable, but it has to be looked into and adjusted further. You know what I mean?
Yeah, no, and that makes perfect sense because, I mean, Right? You don't know what's worth, and those are the most expensive things, right? Like when you bring up seller disclosure, right? Like it's usually the information that the owner knows about the property, right? Like we know that roofs go, last 20 to 25 years, right? We know that water heaters last, I mean, now 2 years, but like, they're supposed to last 8 years. Right. So over time, we know how long things should last. And so that's right. If you have a furnace that is 50 years old, I mean, numbers really say literally any day, it doesn't matter
Yep.
what day it is, any day that thing can go up. Could it last another 100 years? Sure. There's a small possibility, but like really, like the value isn't there. There's nothing to it. Like you should plan to buy that. So
Yep.
right when
Yep.
the seller says, hey, this is a brand new roof, the person, the appraiser can go, okay, hey, this is not even a year old. It's brand new. It's going to last you 20 years. The value is there because somebody's done that work for you. I just had the weirdest thing happen to me today. Somebody was trying to do an appraisal, and they wouldn't do the appraisal until we turned the water back on the foreclosure. Like, so, right, I mean, everything's labeled, hey, it's been winterized, there's nothing on it, and they wouldn't do the appraisal until the water was turned back on. So I thought that was insane. So
Well, it depends on the loan product the buyer is purchasing with. If it's any of the government products, the USDA, the VA, the FHA, it has to be on. The appraiser is required to verify the heat source is working, the water is working, the plumbing is, they flush the toilets, they run the faucet. Now, they're not guaranteeing it's going to work. Just at that moment in time that they walked through the house, they visually saw these items working.
sure.
So maybe it was for the loan product, or even on some of the conventional loans as well too. The property has to meet minimum property standards, and some appraisers will want to see those utilities on.
Sure. No, I'm saying that's good to know because I mean, yeah, I don't know what loan product they're using. I just know I was told to make it happen, and I just thought it
That's
was
not uncommon unless it's a cash or a conventional loan.
sure. And that's what I'm so used to. Now I'm so used to, right, everybody paying cash or hard money or something like that for these loans. Let's say when you talked about refining, at 7%, everybody jumped for joy. When is a good time to refi? How do I know? I mean, I'm telling you here, I'm at 3.75% on some of my loans. When is a good time for me to contact you and refi my loan?
Yep. Depends on a lot of factors. And it's not just interest rate, although that's usually what largely determines when a good time to refinance is. But there could be a lot of factors into that. What we talked about earlier, if you have 20% equity built up in your property and are paying PMI, it might make sense to refinance. I have had folks who have refinanced in the past for higher interest rates, but it made financial sense to do so. They were at a lower rate. They refinanced to a slightly higher rate, pulled cash or equity out of their property to do numerous things, whether it was buy other properties, Nick, or do improvements, or pay off debts, or put the kid through college, or whatever the case may be. But a good rule of thumb, as far as just looking at from interest rate to interest rate, usually if you're paying more than 1% of what the current market interest rate is, you should at least take a look at the numbers and see if it makes sense. If you're more than 1%, it probably definitely makes sense. But if it's around that 1% figure, take a look and see if the numbers work. At the same time, what I like to do with my clients are take a look at the difference in interest rate, but also look at a lower loan term. I have a gal that just refinanced three months ago. She bought her house mid 2018. I think it was maybe August of 18. So 2 years ago. Property went up in value nicely. She must have been talking with Nick before she bought it to see that it was a good buy.
Smart people.
And she was at 30 years. She had a great rate. It was in the 3% range. I don't remember exactly what it was, but it was in the threes. But we were able to refinance her to a 20-year mortgage in the upper 2% range. And her payment went up like $12 a month,
Sure. I say, and
non-existent.
you know,
So
I mean,
she was
we
able
know.
to she was able to shave 8 years off the term of her loan, lower her interest rate,
Yeah.
and not change her payment at all. It was an absolute no-brainer and made a ton of sense to
Well,
do.
I think that's what David's doing right now. I mean, you know, he bought his a while ago. He's doing a refinance.
Yeah, I'm gonna be up about $100 a month, but I'm cutting 8 years off my mortgage, 7 years off my mortgage.
Right. So like it just, you know, I mean, the
No-brainer.
little bit of money is just making sense right
Yeah.
now. I mean, right when he talks to me about it, you know, he's like, "Hey, what do you think?" And I'm like, "Dude, 8 years of your life. Like, think about that. Like, you know, you remember how fast your kid turned 8 years old. Like, that's how fast this is gonna. Like,
Yep.
you'll get to that
Yep.
retirement level. You get to that next step. I mean, you know, when Rob and I talk, it's, hey Nick, you know, you're a long-term player. Like, you know, hey, let's keep these things low, and you know, so I keep my stuff very low all the time. But I do feel like there's going to be a point. We talk about 30 years and refining into 15. So that, I guess that's our next question is like, how many years can I finance for? I mean, can I do a 27, a 12 year, a rent? Like, is there set things that I have to do?
To some degree. With myself, you're going to be doing fixed standard products and programs. So 10-year, 15, 20, 25, or 30.
Okay.
Only because those are what the mortgage-backed security pools the mortgages in, and we get the Fannie or Freddie insurance or FHA or whatever the case may be. I'm not able to do a 27.5-year mortgage. Some of the banks and the credit unions are. They'll just refinance you based on where you're at right now and take the lower rate and leave your loan term exactly the same, because they're not having to bundle and put that into a mortgage pool because it's their money that they're lending and they're not delivering it to Fannie Mae or Freddie Mac. So they'll have different requirements. They'll probably have a lot tighter underwriting standards, which may or may not be an issue depending on the borrower. I mean, Dave, you're a qualified borrower, no issues there. But so yeah, to answer your question, yes, there are some fixed standard products, 10-year, 15, 20, 25, or 30, although
Okay.
some banks or credit unions may be able to do whatever you request.
Sure. No, and I say, and that's good to know because you know, you hear about, you know, usually I guess the normal things that you hear about is a 15 and a 30 year, right? That you can do in between, and that's right. So I mean, the people that, you know, they know that they don't want to spread themselves too thin, but like you could do a 25-year and just instantly cut 5 years off for, I mean, you know, $50 more, and you've guaranteed yourself 5 years off. If you're not that overpayer, stuff like that, I think that's still an option for some of our people listening and people viewing.
Definitely.
Like that's really a cool thing.
So here's a question for you, Rob. Probably my last question. I don't know if Nick has more. So I go through a purchase or I go through a refi. So for example, when I bought my house, I bought it through Exchange Financial. And within a month, I was making payments to a totally different company. How does that work?
Yep. That's going back to the pooling of the mortgages after closing. And it's funny, I'm familiar with Exchange Financial. When I was in the mortgage broker world prior to 2005, they were my number one go-to because they were an excellent company. And I assume still are. I have no knowledge of them since 2005. But yeah, it goes back to the mortgage pooling. So as far as what we do, where I work, we're funding the loan at closing. So your mortgage is with Loan Depot, and more than likely it's going to remain there. Prior to this year with the COVID crisis, I would have told you that your loan, we reserved the right to sell, but we never did. In fact, we were one of the largest net purchasers of mortgages in 17, 18, and 19, purchasing other people's mortgages to expand our portfolio. But we have sold some of our mortgages this year to generate capital for the mortgage crisis. You got sold?
Yeah, I have like 15 mortgages with Chase right now. I swear to God. Like I got a stack of envelopes one day, and it was like Chase, 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 and it was like, you know, you would think that if they bought all my mortgages or whatever,
They'd send you one.
yeah, you know, like it would, you know,
Nope.
and they would figure they'd get their crap together like really quick. No, it was horrible. But it's
Because they
going
have no
well.
clue that you have more than one mortgage with them.
Yeah,
Literally, they have no clue.
they don't care. I'm just a number to them. So
Yeah, there was
They're team
there was a
members.
ton of mortgage servicing transfers this year, multiple times, and that was all because of what was going on in the mortgage-backed security market and the COVID crisis. We could have a whole session here on economics and what was going on there, but the short of it was, as soon as COVID hit and forbearance options were required, mortgage lenders were required to offer forbearance to their borrowers. What that meant was a borrower could put their payment off for 6 months. Might help someone. I don't know. You have to look at it very closely, because on a forbearance, if you took a 6 month forbearance back in May, upon your 7th month, you are delivering 7 payments back to your mortgage lender, because you didn't make 6 payments. Now your 7th month is due. Boom, you need to have 7 payments right then, day one of month number 7.
is that how that's working? Okay.
That's how it works. It doesn't get tacked on. It doesn't get re-amortized in. It's not forgiven. It's forbearance for whatever the time frame is. 6 months is the common. Month number 7, you better bring 6 payments plus your current payment.
So
So if back in May you didn't think, hey, in 7 months, let's say your payment's $1,000. In 7 months, will I have $7,000 to do this? If the answer to that is no, don't take the forbearance, because you're just kicking the can down the road. You're in trouble.
if you have 60% loan to value right now, you've been in your house, and you took the forbearance and don't have the money, feel free to reach out to me. I will say, right. These are called foreclosure things.
Right.
No, it's
Or if you're back working now, call me and we'll look at refinancing.
there you go. Yeah, no, that's a great point. Because you can refinance out of that loan. And now, so we talked about purchasing, right? It takes a month to 45 days is what you were saying. How long does a
Taking a
refinance?
little longer right now. It may take 45 to 60 days maximum, depending if we're getting appraisals back quickly. Unfortunately, Dave, refinances are taking the back burner to purchases. We're still prioritizing purchases, both appraisers, underwriters, and processors. No disrespect, but your refinance, you're going to get processed slower than if you were purchasing. What mortgage lenders have is their channel flow of files. They have refinances, they have purchases, whatever. And this is above my pay grade, so I don't know how they do it, but they may say, hey, processor, work on 6 purchases today and 3 refis, and that's their flow, or whatever the number. Get the gist, not the
Sure.
numbers.
So
refinances are
longer.
taking longer. Some of them, a company that you mentioned, I won't say who, but I know that they were doing 120-day locks on their refinances.
That is insane, Chase. How dare you? Say,
Or so I had heard. I lock all my refis within 60 days, and we're closing within 60 days, usually about 40,
Sure.
50 days.
So, I enjoy purchasing a home. One thing, we've told people, I've worked with you on quite a few. I don't even know how many I have with you, to be honest, 7, something like that. And I get into, it's funny because I have a friend, I don't even want to call him a friend. I have a guy I know who happens to be in your game, and he told me there's no possibility to get more than 4 loans, right? And I'm like, you should meet my lender friend. Like, I don't know how, like he's telling me till I'm blue in the face that I don't own more than 4 mortgages. And I'm just like, all right, hold on. So how many mortgages can I get? How does that work? And how do I prove to this guy without having to pull out my my wallet and say, hey, this is if you want to look at my debt, here you go.
Yep. No, that might be coming back to the internal lending requirement where he is at.
Sure.
Now, yes, there is a limit to how many loans you can get, and that's a bit of a sliding scale depending on what the underlying economics are. That number came down through the mortgage crisis when folks like you and I wanted to go out and buy more properties, they may have limited what we could have possibly done back then. And they did, because I had many investors that I unfortunately wasn't able to finance. But then at the same time, some of those products and programs opened up and allowed more. So that's a bit of a sliding scale, but no, you can have more than 4 finance properties right now. You're going to get into trouble probably when you're in the 8, 10, 12 finance properties. And if they're all with one particular lender, then you might meet some risk requirements there. But at some point, yeah, you're not able to continue to build your portfolio with the residential mortgage market, and you're stepping over to the commercial department. You're doing blanket mortgages across all of your properties. They may take a look and say you have X amount of dollars of equity across all of these properties. So they may issue you a line of credit where you can just go write checks for cash for properties. I hope to work with you to get you to that point someday, and we have that problem.
I mean, I'm at that problem, but that's for another time. I've pulled a few of my places together to open a line of credit for on a commercial loan, which is funny. So just even about that, right? So you say you don't know anything about commercial, and so back in the day, I was this young cocky kid. No, I was young and naive, and so I went to Rob for a 24 unit or 28 unit, and I was like, hey, and he goes, I don't know a dang thing about this, but here's this guy. We talk about Honor Credit Union. He goes, here's this young kid who's doing great things. I hear he's doing well. So Patrick, and so I talked to Patrick back in the day. He's like, yeah, commercial, we can do this. And I've never closed a loan with Patrick, and I've brought so many to him. I've always ended up just putting them under land contracts or other things because the people, they respect me, and they're like, you know what, here, just do it this way, it'll be easier. But Patrick is now VP of like commercial lending for Honor Credit Union. It's insane. Like barely answers my phone call. Like just pawns me off to somebody else.
Yeah, but wouldn't you?
Yeah, of course. I mean, so I brought it. But the good thing is he'll answer my phone call once in a while because he knows that usually I'm just calling to bring him millions of dollars of my friends that are trying to refinance their big properties. So Rob, do you think there's anything that we missed that you can tell us about?
I know. I guess really going back to different lenders, different requirements, overlays. If you're told no, continue to talk to other folks. Just because one bank said no, another or a lender like myself or a credit union might not have that same requirement or might not say no. Especially on different types of credit scores, like for instance, Honor Credit Union. They were talking about them. Don't hold me to this, but I think their credit score requirement is still a 640. You have to have a 640 to qualify to get a mortgage with them, where I can do all the way down to 580.
Sure. Wow.
So just because one person tells you no, continue your search and talking to other folks, because there are lenders out there who have different requirements.
I think that's a big tip. Like anybody that's still listening, I wish we could put this into the beginning. Yep. Well, that's like a huge tip is like you're
no might not mean no when it comes to mortgages.
Yeah, you're 80 points different on a credit score. So if you are getting told no and you're looking for somebody and you just heard kind of what a base credit score that he could do, Rob, tell people more about you, where they can find you, how you want to be reached.
Yep. Rob De La Torre with Loan Depot. My office is in St. Joseph, Michigan, and that's where I live. My phone number is 269-208-2852. And I tell you what, that's the best way. I'll put my email out there as well, but that's the best way to get a hold of me. 208-2852, call, text. My email address is rodelatorre. So RODELATORRE at Loan Depot, LOANDEPOT, loan.com.
Yeah.
Well, and I'm going to make sure this is in all our show notes. So if you're hitting us up on YouTube to see it there, you're going to see Rob's information. If you're listening to the podcast, go to our show notes. We'll have the information there. If you're looking for a loan, definitely get a hold of Rob. It worked for me. It's worked for Nick at least, 30 times.
Once or twice. I say, I
I
think
appreciate
it's
you guys inviting me. This has been fun.
good. Yeah, we really appreciate we really appreciate having you on. We're not going to edit that. It's going to sound great.
We don't edit
I
anything.
say, it's funny because, I have two of your phone numbers, right? Like your personal cell phone and your business line. And I think I just give everybody, both of them. I'm like, here, I'm like, if he doesn't answer this one, call this one and say Nick sent you. And it's like everybody I talk to that I've given your number to is like, holy crap, Rob answers and he calls right back and he answers all my questions. And he, like, even if you don't end up closing a loan with him, you can call Rob and he will pull your credit and say, hey, this is what I would work on. This is how I would get started. Come back to me in this period of time. Like, he sits and says everything that you're going to need to do to be successful. And I really respect that out of you. Like, I've sent you, I've sent you way too many people to buy your beautiful house. So, but I've also, but I also know that I've sent you some people that you haven't used. But you've given them so much advice and I get such great feedback. And I know sometimes I don't give you that feedback right away. So, as I said, we really appreciate it.
Yep.
I know you've helped me along the way. When you're done with this, I know it's like 8:30 at night, but go ahead and just start running all my properties for refis, see what you can do for me. So I'll have a text tomorrow morning that says, hey, Nick, there's nothing I can do. No. So guys, we're going to, as David said, we're going to put it in the show notes, but as always, like, subscribe, share, hit the little bell thingy, smash the dislike button if you hate the beard. And I'll make fun of you every time. But
How long you been growing that?
this is 2 years and a month now official. So yeah, I was gonna cut it and donate it and do all that, but now it's gotten to the point where it's like I want to keep going, see how far I can get this thing. So
My wife will be so happy when you shave that.
yeah, it's just not gonna happen. Like, I keep telling everybody, like, people tell me, hey, you should cut it. And I was like, look, if you donate enough money, like, it's just hair to me. Like, donate enough money, we're going to make it to a good cause and we'll have a good time of it. So I'm hoping that we get successful enough here on the podcast and YouTube that we just make this to where people donate a bunch. And
So if we cut it, can we make, to pay out of it for those of us that are going bald? Because I'm losing my hair up here.
Nobody out here knows that I'm bald under here because I got this golden locks on it. But say, I hope you had as much fun as I did. I absolutely love talking about mortgages, even though it costs me money. I still love it. So thanks so much for joining us. I'm glad you got to partake in a good cider. And guys, if you want a mug, hit us up and we'll figure out a way to get you a Bucks and Brews glass sometime.
We want to thank Rochester Mills and Saugatuck. We know that your sponsorship is coming.
Yeah,
Nick.
Frankenmuth Brewing. Every year I give them money, so I hope that they sponsor me someday, even one. Because they know, as I said, I just bought a case and I should have bought like 3 because it was such a good special.
Yeah, seriously, we will work for beer, and it doesn't. You don't have to buy us a 12-pack or anything. We'll work for a beer.
Yeah, we're thinking about doing like standing on the corner that says "Will Podcast for Beer," just for fun. So.
Well, I'm putting my order in. I want a glass, but I'm going to personally pick it up from you once this COVID is over, and I'm going to bring some beer and we're going to share it together.
That's the deal.
My man, thanks so much.
Thanks again, Rob. We loved having you. Stick around for a minute because we always talk after this. So
right on.
We'll see you guys next week.